Welcome to the Risk Reversal Podcast. I am Dan Nathan. I am joined today by Brett Winton. He is the Chief Futurist at ARK Invest. Brett, welcome to the podcast.
Thanks for having me on.
All right, you and I have spent a little time on CBC's Fast Money, and you've been very generous with your time there. You've also been very generous with, I guess, the back and forth you've had with some of my co-panelists. Kara Swisher, I want to say about 10 years ago, came on the show, and I think she later referred to us as the screamy Fast Money guys. So we can be a little screamy here, but one of the things I'm really excited about, you are easily the first chief futurist that we've had on the program. And I remember you when you were a strategist analyst at the ARK funds, and then you took on this new role. So I'd love to have you explain a little bit what a futurist is, how you work with the funds that you manage, not just public funds, but also private, some of the areas where you think the most innovation is going on. And we can again talk about public versus private and who these companies are disrupting or who they're hoping to disrupt. What maybe the next Mag 7 looks like if we can look out into the future, 10, 15 years, because I think you're a student of history or market history, and you also recognize the fact that it's not always the 10 of the last 20 years, that sort of thing. And then lastly, I'd love for you, and it's not going to be hard for you to do, talk to me like I'm an idiot about some of these things like quantum computing and the like, and how some of our listeners can think about these as investable themes going forward. And then, of course, Tesla. So let's do it, man. First things first, let's go through your background really quickly and how you became the chief futurist at ARK Invest.
Sure. By education, I'm a mechanical engineer. And, I joined AllianceBernstein in the peak week of its stock price. Maybe it's recovered. I don't know what it's done since then, but basically in 2007, and like into the teeth of the financial crisis, imagine kind of the impartial observer who comes in and sees everything fall apart. And as an engineer, I like seeing things fall apart because then I understand how they work. And then I try to put them back together. And so at ARK, we started ARK in 2014. I was director of research at inception. And the idea of ARK is we're going to focus purely on disruptive innovation because there are these, we think, 5 major innovation platforms that are kind of upturning the world that are all hitting their realization stages at the same time. So for us, it's AI, robotics, energy storage, public blockchains, and what we call multiomics, but it's really gene editing and sequencing and everything happening in biotech. And so kind of from the beginning at ARK, our approach was to say, hey, we're going to understand technology first, understand the cost declines in technologies, the future unit economic cases, and then that'll help us understand and underwrite the individual positions. And so kind of as ARK has grown, kind of like the number of positions we're underwriting has expanded as the market cap in these technologies has expanded. And so the move into chief futurist is just to drive the top-down underwriting, make sure we're doing the technologies, the cost declines, the unit economic case as well. Then we have a director of investment strategist to audit the bottoms-up underwriting. And we launched a venture product. I'm on the investment committee in the venture product, and so there's a lot of it expands the universe of companies we can look at, and so do a lot of due diligencing on the venture side. But ultimately, at a very high level, look at what's going on macroeconomically right now. People are saying, oh my gosh, like the entire economy is a little shaky, except you have this huge AI data center spend, and I don't know, maybe $300 billion this year. And that's driving kind of progress in AI. Well, on our forecast, we think that's going to 10x by 2030, roughly, to $3 trillion. And so actually making that call right and all of the downstream effects of it is literally market moving, macroeconomically moving, and determines how valuable these assets ultimately become. And so kind of as the chief futurist role, it's to keep those forecasts on side, to figure out where, you mentioned quantum computing, also to do kind of due diligence on technologies and determine when they're not going to hit a stage of investable inflection over the course of our price targeting time horizon, and then to dig in on the individual positions and make sure we're reconciling how we're underwriting the individual securities against those technology forecasts.
All right, let's do the capex for a second. There's so much there I'd love to pick out. So, let's just say cumulatively over the last 3 years, the major hyperscalers have spent, let's say, $750 billion on capex. Is that fair? Maybe it's a little less, between 500 and 700 or something like that, right? And so
Order of magnitude, yes, that's roughly,
yeah.
I think, in ballpark.
Right. And so you're saying 3 trillion by when? Is that cumulatively, or you think there's going to be?
We think the spend on AI compute in 2030 is going to be around $3 trillion. There's, we have like a kind of sensitivity on this forecast. It's partly dependent upon how much software are people writing for themselves versus they're relying on software as a service. It's partly dependent upon how much productivity gain are they getting off of the software. Businesses usually, they buy software only when it's a really clear ROI for them, as in kind of like the productivity advance an enterprise gets from software. They usually pay like 10% out to the software provider. What's interesting in AI with these new kind of, if I'm going to a business and I'm saying, I'm not selling you software, I'm selling you a virtual customer service agent that you can like for like replace against an employee, then businesses are actually willing to spend a lot more for that, because I think they see it as more kind of like, yeah, we're buying this for now and we can swap out to another one because this is just an agent that plugs in. But our assumption is it's on the order of 5 to 10% of the productivity value businesses capture. And then that leads to an expectation for it's almost $10 trillion in AI software spend by 2030. To support that ramp, you have a like lagged by a year capex ramp to just literally manufacture that software. So I walked through the Tesla Cortex facility, and the most striking thing for me about walking through one of these big AI data centers was this is not a data center. This is a software manufacturing facility that is running 24 hours a day, like taking data and compressing it into a software output. And the same is true for these foundation model companies, where they have billions of dollars of GPUs that they're trying to make sure are 100% utilized at all times to then compress an output that then they're going to deliver to end customers. And so that's the way to think about this capex. This is not, we're not building data centers. These are like the modern software manufacturing facilities that are being built out. And so as of now, companies are getting great ROI on delivering AI software to enterprises. And we think that's going to, like with every performance advance, actually the market seems to be expanding. We think that's going to continue. And so you're going to end up with a huge amount of AI enterprise software spend supported by huge AI software manufacturing facilities.
So right now, the major hyperscalers, their capex is maybe in and around high 20% of their sales, or I think in Microsoft case it was like 31 billion. And everything that you just said supports the idea that this front end loaded spending, which will obviously increase as a percentage of their sales, it increase in absolute numbers, right? But the hope is it would come down as a percentage of their sales. But a company like Microsoft that doesn't even break out their software sales related to AI right now suggests the fact that they are not seeing big uptake in copilots, right? If you can look at like a Salesforce, which is a massively underperforming stock, you would think that they would be able to package some of this software together and replace existing SaaS software that maybe integrates better with each other, right? A lot of folks like you seem to be very focused on this application layer that will be built on top of a lot of this foundation models and the like, but it's kind of early right now. And if you were just kind of focused on the here and now, which maybe a fast money guy might be, you'd say, I don't see it playing out. I would take the over in agents right now. You know what I mean? Like that, all that sort of stuff. So break that down to me, why I'm being way too short-sighted now if I think that we haven't even reached a digestion phase of all this build, and when we get the realization that maybe a lot of enterprises are not ready for this technology.
I think, I don't think you're entirely wrong in that it is the development of kind of an AI software output requires a very different set of processes than the development of traditional software. And so for a company that has a lot of IP and process built around traditional software development, it might be hard to integrate these AI software inputs. And so Microsoft and Salesforce, all of these legacy providers of software. Think about the process by which Microsoft decides what goes into its menu bar, right? And where do we like the formatting bar and what that does, and kind of all of the menu items are things that they've debated. They've decided exactly what goes in there. They've decided how the menus are nested. They know exactly the functionality that happens when you press the button. The challenge with AI software is the foundation model companies are delivering products that they don't know what they're capable of. And so then integrating that into an existing software kind of creates this friction for the user where it's like, well, I'm used to using this software where I select this thing and it does this thing, it does this thing that's predictable. And then there's this funny box on the right side where I kind of type in and say, hey, can you do this thing? And the box says, I can't do that. Or the box does something that's totally unexpected and not what you expected, or it does something magical. And so I think the right way to think about AI into enterprise software is that companies that develop native to this new interface are going to have much more performant, magical experiences for users than existing companies that are going to try to take it and kind of glom it onto the top. And even Copilot's performance within the Microsoft Office suite is much worse than just using kind of ChatGPT's app to access your Microsoft data. Which is interesting because it's basically the same set of models. And I think that the transition here is not just another tool. These are really likely to become operating systems and will require a whole different set of processes to understand how to integrate them into enterprises and into software. And so it would not surprise me if there's kind of a continual struggle for legacy providers to deliver to end users something that is actually profoundly useful, as opposed to something that actually cuts against the way they use that existing software. And the other way, you're right, is, gosh, AI is difficult to integrate into the enterprise because it's not just like software companies that are used to, hey, I set up a process and it happens and it does the thing that's predictable. Enterprises themselves are used to, when they softwareize something, the outputs being deterministic, as opposed to 99.5% of the time, this works the way I was expecting, and 0.5% of the time it does something unexpected. And so enterprises have to treat these AI software products more like they treat employees, where it's like, yes, I think I've trained this employee. I think the employee is going to do what is expected of him. And some employees go rogue or just get things wrong. And so it requires almost like a more human capital management approach to software, which is not kind of the way these businesses are set up. And so what's I think provocative about AI is it can deliver amazing prototypes, and taking those prototypes and carrying them through into automated production is actually quite difficult and requires a lot of work on the back end to kind of like, buy a Palantir system and set that up so that you can have these like automated loops running in a way that they are being sampled or quality checked so that when they kind of spit off something that you don't want. And so kind of like, I think in the near term, for some companies, there is probably this like, oh, I thought this was going to be magical and easy, and it's actually quite difficult. But the fruit that you get on the back end is so ripe and sweet that enterprises are still willing to reach. And at the same time, the foundation model companies are saying, listen, don't even worry about that. We'll provide you with an agent that will solve all of that. And we'll solve all of that on our end. You like pay as if you're paying for a discount rate employee for this agent that then does a lot of the work and error corrects for you. And so there's going to be this tension between kind of the AI first companies delivering really a fully packaged solution versus enterprises being like, well, we want to have more control over what goes on. And so you can look at kind of like the Anthropic's revenue and OpenAI's revenue. OpenAI just, revealed instead of doing 12-ish billion this year, they're going to do 20, or they think. And so like, it's very clear that at the lower levels of the stack, these are profoundly useful products that people are spending money to use. And they've gone from like a $20 a month price point to the high end being a $200 a month price point to trying to establish a $2,000 a month price point. So I think that there's going to be a lot of demand, but that does not guarantee that a legacy software provider is going to be able to be like, oh, I'm going to take this and magically it delivers top line growth to my business, because it's disruptive to their business in maybe a profound way, and at least in a moderate way.
Yeah. And so, Brett, everything you just said will happen eventually, right? In some way, shape, or form, because that is the way technology works, right? If you can dream it up, you're an MIT genius and you're a chief futurist and that sort of thing. And I'll bet you, 75% of what you said will eventually happen. Maybe I don't know what percent will be very, productive, and able to kind of continue. You know what I mean? I'm just saying, like, you're probably going to be right about most of it. But when you're doing mark to market in public markets, as you know very well, I can go look at the list of holdings in the ARK investment. I mean, you guys were the poster child for innovation when investors were tripping over each other to try to get access to these sorts of investments in a way that I guess is risk managed across a portfolio rather than just throwing a dart and picking this stock here and Roku there and Coinbase there, that sort of thing, because you guys have a thesis and you're very transparent about your thesis. And I will say this about Kathy, because I've met her a few times. I have the utmost respect for her. She has done something that very few fund managers have done and are able to do over time. She sits in there, she takes the punches, she is unapologetic about the business that you guys have built, the way in which you manage capital, and I respect that. Okay. And I also think that it's a hard place to be when you become the poster child for a bubble, right? And I think that, 2020 and 2021 into 2022, that's its own thing. What's going on right now, it really is a mega cap phenomenon that's getting to, $4 trillion market cap companies. I don't think either one of us thought 3 years ago that NVIDIA would be a $4 trillion market cap company, right? And maybe not even for Microsoft, and that they would be $1 trillion greater than that of Apple, right? Like, just think about how some of this stuff sorts out. So before we get to OpenAI, and I want to spend some time on OpenAI, do you think that the current winners that have accrued most of the market cap in the public markets, and obviously it's NVIDIA, the hyperscalers, and Broadcom and the like, do you think that those companies will be the best way over the next 5 years to play generative AI in the public markets? Because I heard a VC on CNBC the other day, a guy that I know and I like and I have a lot of respect, and the comment was that the hyperscalers are the best way to play generative AI, in the near term. And I just can't believe that's true. I can't believe that NVIDIA is going to be a $10 trillion market cap company in a few years. I cannot believe that there will be not a chip manufacturing company in the world that doesn't figure out to do a whole host of different things that NVIDIA does well and attach some software to it. And maybe it's from China and maybe it's from some companies we've never even heard of, that sort of thing. But so the question is, long-winded way of asking is do you think these companies that are worth $15 trillion in market cap are going to be 30 in 5 years? Are some of them going to fall by the wayside? Is the compute that you're talking about that they're spending all this money to build, maybe it's Microsoft or Google Cloud or AWS or, is that going to be the way forward in the next few years to play this trend?
Yeah, I think it's important to deconflict two phenomena. Okay, so if you look at, for instance, the multiples of those mega cap tech companies versus the multiples of broader kind of disruptive tech as we define it, they both structurally moved up during 21. And then anything with a thinner balance sheet got severely punished by the market on the back end of that cycle. Whereas look at Apple's multiple, it basically just stayed elevated as if this was the new normal for Apple. It just wasn't the new normal for everybody else. And I think that's a byproduct, not of the actual, net present value of cash flow that Apple's going to accrue, but more a byproduct of market psychology, where people we're kind of it's I get to have technology and be safe at the same time, and that's the way people feel about Apple. It's oh, this company is you set it and forget it. There's a lot of money that's in there that has a big capital gain, so they're disincentivized to sell. I was talking to a friend who helps manage money. I was like, why are you in this stock? He's like, listen, like I have to be really convinced it's in trouble because of the tax hit of actually, selling the position. And Apple is potentially in severe trouble, right? Their AI product is a joke. I mean, they really, I think the operating system is changing underneath them, where the way in which consumers get access to technology is fundamentally shifting. So then the economic primacy of the iPhone becomes less important. They're pissing off their developers left and right. Their goggles are, certainly not consumer adopted in any meaningful way, despite the money they've sunk into them. They canceled their car project. I love the watch, like that's where I'm at. And I guess the AirPods. And so it's not to say that Apple can't continue to be a mature company that generates cash flow, but there's all kinds of indications that their ability to magically create these service margins and growth could be, at least it's under threat. And you can go across the board. You can say, well, Google's search is like really its primary cash flow generation engine. And people are no longer going to search for their first kind of like grasp of information. At least the people, the hundreds of millions of weekly actives that ChatGPT and Grok have. Right?
700 million.
Right.
700 million. I mean, that's
a lot, but it's also only, we have 8 billion people on Earth or whatever. It's like, so it's a lot, but it's also a little. And I think you would say, like, early days of the internet, it seemed like everybody was on the internet, but it was still very small and people were constrained on dial-up. So I still think we have those unlocks to come in AI land. So the net of it is, I think those big companies are potentially subject to disruption. If you look across kind of the life cycle of ARK, usually that Mag 6, excluding Tesla, has been about a third of innovation market cap. And during kind of like the post of the bubble where they stayed at a high multiple and everything else got compressed, we think it's roughly 60%, at least as of the end of 24. And if you look at our forecast for those companies, we do 5-year forecasting on all of our companies, and we own some of them. We own Meta. We think it's really well positioned. We have some NVIDIA. It's not a super outsized position. We think it'll return, those companies will return to roughly a third of disruptive innovation market cap. But we think disruptive innovation market cap as a whole is going to move up to a number approaching $200 trillion. And I'm including crypto assets and cryptocurrencies in there. So, like, is it the best way to play what's happening in AI? I don't think so. But I do think they will benefit, as in our underwrite for those companies suggests, hey, these are reasonable investments to make, but there's more risk in them than there has been before. And if they only get up to 30 trillion collectively, that may be seen as a net failure relative to everything else that's going to come. And another way to think about it is, okay, so we have a chip cycle that NVIDIA is in front of, and I agree, there's a lot of competitive vectors against NVIDIA. Their gross profit is basically a giant blinking advertisement for come and get us, and so everybody is like, yes, I don't want to, Tesla does not want to send $7 billion a year of gross profit to NVIDIA if they can build their own chips that are as performant. Same with all of the, Amazon is using its Trainium chips and Anthropic is training on them, right? So there's definitely AMD, maybe has credible products in the works here. Then there's, okay, well, who is kind of like buying those NVIDIA chips? Who are the big volume purchasers of it? And those are the hyperscalers. And you say, well, that's the, and the core weaves, that's another spot you could be in. That's kind of one step downwind. Then it's like, who is using those chips to the best possible advantage? And that's, for us, Tesla is best positioned there. They're buying a ton of NVIDIA chips, and OpenAI, and Anthropic's not buying NVIDIA, and Anthropic, they are investing lots of money in this stuff because they're getting, we think, great ROI on it to deliver products to end consumers. But you could also look at who NVIDIA itself is investing in. They're not investing in Tesla. They're investing in kind of like the biotech AI-driven drug discovery names, because that's where you have essentially an infinite data resource that's heavily underexploited, and you have hundreds of billions of dollars of annual R&D spend that's heavily inefficient. And we think these chips are going to drive efficiency into that space and transform really like the healthcare space. So that's a way to stage it. And then you have kind of like as an alternative vector, everything that's happening in crypto assets, and kind of that's both enabled by and kind of like synergistic with what's happening in AI.
And I want to hit crypto too, but I just want to hit this one last thing about the hyperscalers and Meta. This is my good friend Jim Chanos. He tweeted this last week after the Meta and Microsoft earnings. He said it looks like Meta's depreciable life on its capital base, $210 billion at the end of Q2, was 11 to 12 years as of the second quarter. If the most true economic life of its GPUs is actually 2 to 3 years, most of its profits are materially overstated. Now, that's just math. Right. And so this has been something a lot of folks have been talking about as far as, how this spend is being earmarked for depreciation and the like here. Do you think that this is something that's going to be a huge issue? Because it's not just like the way that these are being accounted for from a depreciation standpoint. If you listen to Jensen, we had Hopper, then we have Blackwell, then we have Rubin, and they're making all the cases why, every 18 months, you should be moving along up the stack, right? Or as you get these steps in performance and the like, okay? So I'm just curious how you're thinking about that, because I noticed if I'm looking at ARK Invest, I didn't see Microsoft in there. I don't see Google in there. You have a little bit of Meta, which you just mentioned. These seem, do I see Amazon in there? Maybe small?
Yeah, we have some Amazon. Small,
yeah.
But,
and so when I think about that, I mean, do you see these as potential headwinds, just some kind of financial engineering in some of these big hyperscalers?
I can, at some point, that will be an issue, I would predict. Like, as in, our read of the cycle right now is definitely this next NVIDIA chip cycle is clearly a big investment cycle. Those chips are going to be fully utilized. We think at least the one after that, it might not all flow to NVIDIA, but there is going to be a lot of, like I said, like a 10x expansion in demand for accelerators. The things that could kind of short circuit that is if distributed training compute becomes a more meaningful way that you can train these models, that potentially disrupts it. So Tesla is talking about, hey, we have all these chips in cars that are underutilized. Tesla is going to shift to an architecture where their car chip is the same as their training chip. So then they can, when the car is parked at night, potentially like shove workloads to the car. And maybe the consumer gets, money back for providing their GPU. They're basically paying for the electricity that's powering the car, but the car has like on-site cooling and stuff. There's a lot of reasons why it's like you'd rather kind of like train distributed rather than kind of in a giant 100,000 GPU data center. But as of now, what's happening is the reason they've extended their depreciation life of the chips is, yes, first you have these like highest cost chips that you're using for your most important training runs. Then you spin up products that need to be run on these chips. And as the chips kind of lengthen in their age, you can still have products running on them and deliver products to end consumers that are based on AI on these older chips. And so the utilization rate of these older chips continues to remain high. And if you think about like if the next spend is another 5x larger than the current spend, then it's actually absorbing that legacy kind of infrastructure is not that hard. It's like you're developing products that then still need to run on something. And so kind of the effective like economic life of the products is actually lasting longer than people expected. And it's like reasonably important to Meta. It's really important for a company like CoreWeave, right? Where they are, in some cases, borrowing money to buy chips that then they're selling off. And so it's kind of like collateralized debt against these chips. And so if you had an expectation that suddenly like 3 years from now, the chip they install today is not going to be worth anything, then it would be really severely detrimental to their economic model. And so that was like, we did, a lot of kind of like talking about that and talking about the mechanics of it to underwrite kind of CoreWeave and the other neo cloud type offerings. Lambda's another one. And right now, I think it makes sense. And it's partly, I mentioned that $3 trillion CapEx number. That's not actually really all CapEx. That's the number of like, that's the combined, I'm investing in capital to produce more software products that I'm going to sell next year. And this is just the amount of compute I need to run these software products that I'm on selling to enterprises. And that's actually a much healthier dynamic where it's kind of like I invest capital, it rolls into my, cost of goods sold for the software I'm selling to enterprise. And I'm just, it's lined up against my demand.
Is that $3 trillion number, is that global?
Yes.
And so that includes China and the like. Okay.
Yes.
Ish,
I mean,
ish,
ish.
ish.
Like
Okay.
we treat China and software as almost like a separate bag because they don't tend to spend for U.S. software. And I mean, I think China is increasingly relevant here because of what they're doing on the open source side. And so there is like competitive dynamics there. But the way we do it at a very high level is like, this is how much people are going to spend on knowledge work salaries. And then this is how much they're going to spend on productivity against those knowledge workers into AI. And if right now we're spending on the order of $30 trillion on knowledge worker salaries, like, it's not that unreasonable to say, hey,
And you're a knowledge worker. Are you going to be replaced by an agent, Brett?
well,
I mean,
no,
like,
I think if I weren't using an agent, I would be replaced by somebody who was.
right.
I mean, I think the
Intelligent assistance, right? We'll just turn that AI around a little bit. Yeah, and I get it. And that's where a lot of this productivity is going to happen. Really quickly, this is a day where Palantir is at a new all-time high. It's trading up 7%. They just raised, everything's great. $410 billion market cap on what's expected to be, let's say, $4 billion in sales this year. They crossed the quarterly mark of $1 billion for the first time ever. The company is profitable. I mean, it's not like that profitable, you know what I mean? But like, I have never seen a company trade at 100 times sales where it's just the excitement in and around this. I mean, you would say this is like, you can go back 25 years and you could look at like price to sales multiples or this or whatever, but just this seems a bit egregious. And so I guess at what point, this is the 7th largest holding as I'm looking at ARK Invest holding, at what point do you say this is one of the biggest bubbles in stock market history on an individual basis? Now you could say, well, NVIDIA's got a $4 trillion market cap, or Microsoft has. Well, they also have like I don't know, what is Microsoft going to do? $300 billion in sales this year or something like that. You know what I'm saying? So help me understand Palantir, because I've referred to this as the dumbest fucking stock I've ever heard of, like, or seen in the market. Like it just doesn't make any sense to me. But obviously the people want it. So give the people what they want, I guess.
Well, so the way to, I think, to understand it is think about the way software revenue flows through the stack, right? I go out and I buy, I don't know, think of like a narrow special purpose software as a service, MindBody or something. I'm like a set of, gyms, and I need to have like the application that's built specifically for me to manage appointments and stuff. And so there's a software as a service product attached to that. That software as a service company takes that, and then they spend on kind of some platform as a service type things like database, MongoDB, or maybe they spend on Palantir or something to help them manage. And then the platform as a service companies then spend on infrastructure as a service, like they go to AWS or they go to Google Cloud, to then actually run their underlying computer. And then the hyperscalers, these infrastructure as a service guys, then spend on chips to support it. Used to be CPUs, now GPUs. Well, what's happening is that we think that the top of that funnel is kind of like narrowing and it's breadthening out, where the gyms of the world are no longer going to go to MindBody. They're going to be like, hey, we need like an appointment app. Let's just spin it up ourselves. We can just, vibe code the specific product we need. So why am I spending for this off-the-shelf software that's hard for me to learn when it's easier for me to do this function by just like coding it myself? In order to do that, you need to have a good platform that keeps track of all of the things you developed and helps you to run them. And that's what Palantir and Foundry basically do. Now, that's like a narrow example, but across a broad enterprise where you have all of this data coming in, you're needing to develop effectively custom software for yourself that's built on all of that data. Then you need a really good general purpose platform for both kind of digitizing and regularizing your data, and then attaching the custom software that you're going to build on top of it. And so kind of I mentioned this like AI software spend, that's not, we think actually maybe as little as 10% of that is going to be on traditional software as a service. A lot of it, instead of starting at that layer, is going to flow into the platform as a service layer, which Palantir provides. And so at ARK, we use Foundry, we use Palantir, we're spinning it up because we think it's the better way to manage kind of like the data on the companies that we're analyzing to do underwriting of companies, to like intelligently apply kind of AI language models against that company data. And for very big enterprises that have lots of data streams and lots of raw data that they need to process, traditionally you would have just had like a machine learning team that would go after that stuff, and they would find Palantir useful. But now kind of like that system becomes useful to everybody in the enterprise, where you need every single endpoint person to be able to be like, hey, I need to like develop a little software widget to help me do this thing better, faster, more efficiently, with better customer service, cheaper, provide an answer better. And Palantir is setting itself up as the operating system layer that enables all that activity.
But again, if you tell me that they're going to start accelerating revenue growth to 100% a year, from 4 to 8 to 16, that sort of thing, it might grow into that multiple, but that's not happening. You know what I mean? Like, so, 50% revenue growth year over year might be as good as it gets. And so help me understand, like, the way you think about managing risk. If this, let's just say the stock continues to go higher because we're in this crazy bubble as money is moving away from, let's say, the hyperscalers and trying to find new, better ways to express the theme, you could make the argument, well, that's why CoreWeave is up 200% from its IPO or more, that sort of thing. At some point, isn't this the poster child for just a bubble away from the most defensive ways to play it, which you just kind of articulated with the hyperscalers and the like?
So, like, I think you have to one, like, you're presupposing that this is just a function of capital trying to find the best way to play it, as opposed to, like, our process is, for all of our companies, we go forward 5 years. We say, what is the top line going to be? What is our estimate for kind of like their gross profitability on that top line? And then kind of given what we think the conversion into cash flow will be, what if we're a forced seller at that point at a reasonable multiple, not an absurd multiple? Can we get a return? And the return we require is 15% compounded over 5 years. That's across all of our positions. Given our expectations for what's going to happen in AI software, and then the share shifts in software from software as a service into platform as a service, Palantir is still a good underwrite on that basis. I would contend that this is not simply a function of people who are like, I have to play AI and then I'm jumping into Palantir. You can underwrite and say, hey, this is actually a reasonable return. And that's at a, like I said, a non-elevated multiple. You can make a bull case where you say, well, this company is kind of inserting itself as the data custom software layer across a huge raft of very large enterprises. And that function is going to be very hard to displace into, like, to move from them into another function. And so you should pay a heightened multiple for it because it's like more predictable cash flow that they'll generate.
Yeah, and I guess, but then there's expectations, like you just mentioned, how you kind of work top down, bottoms up, and then you have the theme, and here's how you're thinking about playing these things. But I think people just forget that in 2022, from the highs in 21, NVIDIA and Netflix and Meta and Tesla, I mean, they sold off 70% from their highs. And for no reason other than they got too lofty in 2021 because there was, a retail-led, sort of bubble in risk-taking, in the markets. And so I just, one of the reasons why I sound this way, about some of this stuff is, like, these stocks will get cut in half again. Like, you can take that to the bank. And so a lot of folks out there who
in
have
half from where is the question?
Well, that's
as in like, people for we were the first public fund manager in Bitcoin, and people were like, this is a crazy thing to do. Why would you invest in this asset? It's so volatile, and every bubble in Bitcoin, there's been like 70-80% drawdowns in Bitcoin. And then if you look at the long, like, history of the price chart, they look like little molehills next to the mountain. And so there is no doubt that disruptive innovation is volatile because it is subject to, people can paint a picture onto it that does not necessarily match reality. And even if the picture they paint onto it does match prospective reality, which is what I think we're doing, people can then doubt that picture because you need the evidence to hit. But there's a few things that are happening here. One, the evidence, like the reason I'm, I feel things that we've been underwriting for, since before ARK. I did my first robotaxi model in 2011, demonstrating this is the price per mile these things could get to. Well, these vehicles are on the road today. Like some of these things become undeniable and begin to flow through to the income statements of companies where people can no longer avoid underwriting them, even in the event of a market downturn. So that's one characteristic that's happened. The same with like cures for diseases using gene editing. These are going to commercialize. Like over the next few years, you'll see a number of them. I think they're going to be remarkably valuable. And right now, if you're painting this picture of, hey, this is a bubble, like look at the biotech space. That is not a bubble. This is like
but the publicly traded stocks, the publicly traded stocks trade like dog shit. I mean, they trade like they're in a bear market in biotech. You know what I mean? Like, so.
Well, yes, but that's what I'm saying. Like I'm saying that there's across technology, there is some degree to which we can kind of arbitrage and say, hey, there's elevated expectations here versus zero expectations here. Let's overweight the portfolio towards some of these technologies where kind of the realization cycle is yet to be recognized. And I think that like investing in innovation is something that you don't do with, depending upon your net worth, with 100% of your net worth, because you accept the fact that there's going to be some natural volatility. One of the reasons that we, like you said, kind of like poster child of the bubble, but we just kept doing what we're doing, which is trying to provide 100% exposure to disruptive innovation in an efficient way to end clients, including, so we don't in our funds go into cash or go into kind of, hey, we're going to like invest in utilities because why? Instead we're going to provide what we think is well underwritten exposure to innovation. And if you look at the history of kind of like financial manias and bubbles, it's like in .com, the last 40% of the game came in the last year. Like there's also
came in the last few months. Yeah. I mean, like I was there, trust me. Yeah. It was insanity. Everyone knew it was a bubble. They just didn't know when it was going to end.
And there was on the back end, there were incredible values you could pick up if you understand.
Yeah, but you know what though? And I think you were doing really smart stuff at MIT during all that. And before you got out, there were very few. And the NASDAQ took 14 years to get back to the highs. And, I could say that there was Amazon and there was eBay and there was like another dozen sort of values, but they took years to really like kind of go anywhere, and really years before Web 2.0 got folks excited about the next leg. And then you had the convergence of mobile and social and broadband, all those sorts of things. A lot of things had to happen for that to work again. You know what I mean? Like,
yes. And I will say in AI in particular, we've done a lot of cost decline work and performance improvement. Things are happening more quickly than any technology we've studied. Like if you look at the performance per cost, it's kind of, depending on how you measure it, you could say we made a 50x improvement this year. And if you leave aside what's happening in mega cap tech, like look at OpenAI and Anthropic's revenue and their revenue growth. Every like step change in performance per cost seems to not, people worry. It's like, oh, you get much more performance for same cost, then the market's going to collapse. No, the market expands massively. I think the fundamental technological driver in kind of like the knowledge workspace, there's still so much performance improvement room. And even if you cut off progress today, I think enterprises would spend like 5 years just like taking the capabilities we have and successfully building them out into their stack right now. Like there's on the table for everybody, there's lots of productivity gain to be had, and the underlying tooling is improving very rapidly. And so that's why, I think that to give you a sense, overall IT spend across the whole stack is on the order of $4 trillion, including telecom. We think almost $10 trillion is going to go just into software, into AI software, and it'll be a great underwrite, within the next 5 years. And so there's a lot of downstream across all of the AI kind of enterprise basically market cap. We think that there's going to be on the order of $90 trillion in enterprise value by 2030. Compared to like a global equity market that, a couple years ago was on the order of $100 trillion. Like there's going to be a huge enterprise value creation event here. And it's because you're going to make people much more productive. You're going to deliver all these, radical improvements to people. And so kind of on that basis, now, does it necessarily happen in 5 years? No, it could happen in 7, it could happen in 10. But over the course of this business cycle, I think you're going to have a huge enterprise value realization event. Not all of that accrues to public software names. Actually, I'd say the mega cap names, I think net underperform relative to others. But it's not something that I would happily stand aside from. And I think that people have a lot of risk against it that they don't necessarily realize. Like you own a small business, your small business is printing money. Therefore, you're like, I have all this wealth. Well, I'm going to invest it to make sure I'm secure and safe. So I'm going to go into like the core index. And then the core, the banks and like the rails all get blown up in your core index and your small business gets disrupted by AI. Well, you better have owned like a huge AI exposure to make up for that risk that you're taking on in your core set of assets.
All right. So really quickly you just mentioned the potential underperformance of the hyperscalers, the mega caps, right? So when I think of just the cloud and the margins, the operating margins for Microsoft and Google are far below that of their overall margins, you know what I mean, in their business, right? So as cloud becomes increasingly more commoditized, right? And that's going to be a function of also how a lot of these models are going to be increasingly more commoditized as you move more into like the inference phase, right? Once you get the most of the, training, right, done for the most part. So how do you think about, like for me, I think that's a huge issue. Amazon's the exact opposite. I just read this the other day, right? We know how thin their operating margins are on 3/4 of their revenue, right? And so the margin that they're getting is actually pulling up the company margin. So that's something that I think will be very interesting as it plays out, right? As there's other ways in which to express these sorts of views in the markets. All right, I got to hit this because I know you got to go soon. OpenAI. All right, so you are a private market investor. It seems like this is a company that just raised at $300 billion. I think they're talking about raising at $400 billion. We've never seen private companies. There is Aramco, and that's it, right? And that's a pretty unique situation. You could say, well, a lot of the data that OpenAI is dealing with, that's the new oil, and you hear all that crap or whatever. So maybe that's an interesting sort of comparison or not. But a couple questions, okay? So we were talking about enterprise software. We were talking about consumer software, consumer search, this technology. If you think about Gemini being worked across all of the suite of, Google properties, and they have 5 with 2 billion monthly actives and, all that sort of stuff, okay? So OpenAI wants to do all of that. They want to disrupt Microsoft. They want to disrupt Google. I mean, the list goes on and on. Is this company going to be the next $2-3 trillion company? Now, is it even possible for it to do it in the private markets? Because how does a company like this, A, go public, B, challenge all these incumbents, C, partner with most of them, you know what I mean? That sort of thing. So just talk to me about OpenAI. Are you guys investors? And do you think this is the most disruptive, innovative company on the planet right now?
Well, I don't know about the most disruptive and innovative company on the planet, but we are in our venture fund, we invest in OpenAI. It's, I think, a top 3 position. A high level way to think about it, I think you have to distinguish the consumer side from the enterprise side. There's a degree to which they overlap, but I do think they are kind of different plays, and kind of monetization models will look different between the two. On the enterprise side, I described software as a service into platform as a service. There's another layer here, which is the foundation model companies. And so we think of the candidates for this foundation model company exposure is OpenAI, Anthropic, Google with Gemini, Grok, xAI, which we also invest in. And, potentially you throw in a Chinese name there or something, or open source meta type stuff. I think OpenAI has the best bid at that part of the stack. We think that part of the stack is going to be worth $15 to $20 trillion in 2030. Okay, so like you have a 15 to $20 trillion enterprise value bucket into which you probably are going to place 2 or 3 companies, with one having the majority of that. So yes, could OpenAI become a $10 trillion company? That's in play, I think. Then at 300 billion, you say, well, like you have to do dilution and there's like expectations for additional fundraising, but it seems it's like a pretty reasonable kind of return on capital play if you believe that future. Then there's the consumer side. They haven't yet optimized to whatever the advertising model that they use against ChatGPT, but it seems pretty clear these things will become purchasing agents for people, and they'll get a piece of the transactions they deliver people into. And that'll be the new kind of like advertising unit. Like just like Google figured out, hey, cost per click is search. It'll be some kind of like agent-based transaction fee. And that should provide them, like you said, 700 million weekly actives. A small minority of those are actually paying for the service. And most people don't realize how powerful it is because they use it just on the free tier. But if they can line up monetization against that free tier, as opposed to it being lead generation to the paid service, then they can actually expand the utility of that free tier in an underwritable way. And people will begin to use it more and more. And it becomes more like the entry point for people into kind of their consumer lives. So, and then I think they could go public. I mean, I think that it would not surprise me. Across all of the AI companies, these are right now extremely capital consumptive businesses. So, getting into the public markets to raise capital against their future capital needs, building up to this platform that we think becomes very cash flow generative, that would make sense for them strategically. And in the meantime, I mean, I think, on the private side, like I said, we also invest in Anthropic. So we think that these are really well-positioned companies strategically that are going to deliver a lot of profound value. And I'll take issue with one thing you said a few minutes ago, which is that the agents are destined to commoditize. I disagree. Think about it. Like if you insert an agent into your business and that agent can learn how the business works along the way, so it gets better and better and better. Then if you say, hey, I'm going to swap this out for an agent from another company, that's like firing an employee. Like suddenly you'll take a productivity hit. You have to retrain this employee. Well, you don't just have one agent. There's going to be thousands of agents sold into enterprises. And there will be all kinds of ways in which it'll be more convenient to pay the fee to continue to use your existing agents rather than trying to like wholesale extirpate your set of agents and then insert another set. So I think that there's an opportunity to actually, have a lot of margin accrue to kind of like the agent providing company.
Two more things, if you don't mind. All right. So there seems to be a lot of debate, probably among many futurists, what exactly AGI is. And now we keep hearing about superintelligence. This is something that I think Zuck is very focused on here. What is your definition of AGI and superintelligence? And are they kind of like just an iteration from AGI to superintelligence?
I'm convinced that people will keep moving the goalposts on what we mean by performance here. And that there is kind of like media and commercial incentives around defining around laying out these very kind of ambiguous but sparkling sounding terms and saying we're going to go towards that thing. And so one of the media incentive structures is people love to hear that AI is going to doom everybody. And so there's a whole set of actors out there that are happily going to be like, this is going to eliminate 40% of jobs. And this is going to, cause humanity to go extinct within 5 years. And so the media, I mean, no offense, you're in the media, but loves to glom onto those stories and elevate those voices. And because of that, there's incentive to like make that claim. Then similarly on the development side, Zuckerberg is trying to, hire employees away from other organizations. He's trying to lay out a big, ambitious kind of like mission to go after. OpenAI also is trying to, convince people to develop onto their stack, convince people that the capabilities that you see today are just the very, very tip of what's going to be a massively expanding iceberg of capability that's going to surface out of the water. And so the entrepreneurs are also incentivized to say, this is going to be, this remarkable set of capabilities that accelerate away. And so those two factors cause us to like set out these terms and say, oh, this is when it's going to be, magically everything is possible. Now, I do think these are remarkable technologies and they're going to create lots of capability. I just don't know how useful it is to set an arbitrary name on a set of capabilities that people at the time that we have that set of capabilities will then define another arbitrary name for. But there are like commercial benchmarks that matter. Can a car drive itself? Can I like ask an agent to write code for me that generates code that works and does what I want at the time without like creating errors and kind of spinning off into oblivion? Like there's real practical, like, is this useful benchmarks that I think are more meaningful than the kind of like ambiguous, we've hit the age of AGI and superintelligence. The technical definition between superintelligence and AGI is like, hey, this is like human level capability, and superintelligence is, can I create a system that then makes itself more intelligent over time so it like massively exceeds human level capability and kind of spins up into like super capability.
All right, last thing, Tesla, Elon Musk, the auto business, in my opinion, is probably the worst it's ever been. You might take issue with that. We'll just look at what's happened on pricing, on auto margins, on regulation, on his lack of focus on the business. He controls SpaceX and Starlink and Neuralink, and he has all these funky relationships with like people like President Xi and Putin and Trump, obviously. And so that's my take on him. And he doesn't play by the rules. The rules don't apply to him. Okay. So then if you say Tesla, forget the auto business, you don't care. It's going to underwrite a bit of the Optimus and robotaxi and all that sort of stuff. And I'll take the over when all those things are commercially viable. And I'm not a futurist and all that sort of stuff. But if you just look at the history of Elon over the last 20 years, take the over, right? Like he's done extraordinary things, no doubt about it, but take the over. So my question to you here, with $1 trillion market cap company, and you guys think this is going to be a $10 trillion market cap company at some point. You look at X and XAI, and they're probably going to be a part of Tesla at some point, right? It's going to all be mashed up together. Thoughts here on how this goes to 2 trillion, I guess back to 2 trillion, and then continues to go, because a lot of things have to happen with robotaxi. I don't even think Optimus is part of it right now, but robotaxi, right?
Sure. I mean, well, there's like a number of statements that I'm like eager to deconstruct there, but I can't go into all of it. But I think there's a dangerous thing that you're doing, which is conflating like Elon as the person who's driving forward these individual businesses somehow then becomes solely responsible for everything the businesses do. Tesla is Elon plus the tens of thousands of employees that are kind of operating and driving kind of the business forward under him. And
are they though? Because you think about look at the turnover in the C-level suite just in the last 6 months, and this has gone on for years and years. And so when you think about who is, he's a guy who punches down, and he like doesn't act like the sort of leader that a lot of folks would expect in an organization. You just said that he's got these great teams. As soon as you disagree with him, you're gone.
No, or at least that's not my understanding of the culture. It's more like as soon as you stop producing what the company needs, then you're gone. So there is plenty of room for people to disagree with the take he wants to, the direction he's trying to shift things. And generally, he has good instincts. I mean, the reality is I have 2 Teslas, the best cars I've ever owned. I will never own. Well, who knows?
Do you have the 3 and the Y?
I have a X and a Y.
Okay.
They're amazing. They're amazing. I literally could not live without FSD. Drives me around with my kids.
Do you have kids? You put your kids in it? You really?
It's the safest car on the planet. Like actually, if you make a financial decision to buy a new car today and you're not buying a Tesla, I think you are not objectively looking at the data and figuring out what is the best like risk.
Why have less than 5% of Tesla owners bought FSD?
I think it's a good question. I think it does. There is a learning curve to using it. So I, as someone who have used it all the way along from version 10 all the way up into version 13, you really can figure out when you can 100% rely on it versus when you have to pay a higher level of attention. And so those cases where it's kind of like you feel like, okay, I need to pay more attention here, that's its own learning that people have to do. And over time, they've diminished. So my test case is my wife, who is generally like late adopter of technology and hates when any user interface changes and anything. And it's gone from she would never use FSD and actually disliked that they changed the highway mode from just lane following to it changing lanes itself, to now she uses it probably 60 to 70% of her miles, whereas I'm like 95 to 100, right? And the version I wrote in Texas, there's nobody behind the wheel, right? And so there's clearly another step change improvement to come. I think that but the focus on whether or not people are paying for the software is actually the way that analysts currently underwrite the business, but it's not the way to understand the business. Think about it this way: they sell a Model Y to me, maybe they're getting like $8,000 in gross profit off that sale one time. And they have a huge factory spun up to produce them. And so actually that gross profit line is really sensitive to aggregate demand for vehicles, because you're depreciating the factory against the lower volume. Then that actually, hurts your gross profitability, which is why autos is a really bad, hard business. Like, you have to sink billions of dollars into factories, but then the output of that factory is being demanded at a really volatile, like macro cyclical rate, which is why auto manufacturers go out of business. If instead that Model Y drives off the factory floor and becomes a robotaxi, okay, and say it's doing $1.50 a mile and it can go 50,000 miles a year, the cost structure against that we think could be around 50 cents a mile, but maybe it's as much as 80 cents. So 50,000 times 80 cents in gross profitability per mile, that's like $40,000 in gross profitability per year for as long as that vehicle's around.
All right,
why would they sell to me?
Why? Let's take a step back.
Shift it into robotaxi land.
Right, but until they get to some sort of scale, this is like going to be like a
no,
money
but it's not
pit.
a function. No, it's not a question of scale. As in they have this scale. It's until they can take clearly you're not doing this at 80 cents a mile if you have to pay somebody to sit in the passenger seat to nanny the system. Right. So the real question on when that occurs is like, at what point can they take that person out of the vehicle? And they have like an operator network behind that's monitoring the vehicles, but where they don't have like a one employee to one vehicle relationship. And that's when kind of the robotaxi business will work and they'll be able to scale and print money. The way we look at it is like, if you look at the performance of FSD, and then you look at the underlying compute that they're throwing at training the system, basically manufacturing the software that runs FSD, there is a pretty clear log relationship between their intervention rate and the amount of compute they're throwing at it. And so we think they cross the commercialization threshold sometime late this year. Could it happen next year? Yes. Does it actually, like, if it happens in the next 6 months versus the next 12 months, does it materially change the net present value of cash flows that you get off of the business? Actually, not that much, because once it happens, you get to throw all of your production, or at least all North American production, into delivering robotaxis to a market that it'll take you a while to fill all the demand you can create.
And you think those are consumers buying those? You think those are Uber drivers buying those? Like that's what I don't understand. Like, who's going to own the fleet? Because if they're going to be producing the whole idea of depots and cleaning them and charging them, or having it come out of your Model Y, come out of your driveway and go to a depot. I mean, this is sci-fi shit. I mean, this is not happening in this. It's not happening in this decade.
It's happening in Austin right now.
No, it's not. Who's going to own the fleet? No one wants to own these fleets.
Well, now Tesla's on balance sheeting them. They could collateralize debt, fund the cost of goods sold, and hold them on balance sheet. My guess is they will sell them to operators. The real question is, like,
what percent of Ubers? All right, hold on a second. What percent of Ubers are owned by operators? It's like less than 15%.
But of course, because Uber, you have to attach a driver to. It's like, the fact that the driver has to sit in the car means the driver's going to own the asset. If you don't have to have the driver sit in the car, then somebody could run a fleet. Because right now, if I'm going to run a fleet of Ubers, I also have to hire Uber drivers. That's very hard to get the labor in place to run this stuff. So think about it this way: if Tesla can either get 8,000 gross profit for selling to me, or some tens of thousands of dollars in gross profit for either on balance sheeting the asset or selling to an operator, why would they sell to the individual anymore? And if you want a Model Y, like, you probably have to buy it sometime over the next 6 months, because I don't think they're going to be available next year for individual.
No, stop it. I mean, come on. I mean, like, give me a break.
People,
and you know what?
If you want the option value of having your own vehicle that can drive itself around, your own vehicle that becomes its own chauffeur, like, better act now. You're gonna try to buy a Tesla, and they're gonna be like, well, we could sell it to you, but we have to sell it to you for $250,000 because of how much gross profit it would generate.
Oh my God, give me a break. This is going to be maybe like a 2032 thing, but again, you're the futurist. Listen, you and I can
a 2030 thing. What planet are you
because
on?
these things don't scale. I love Waymo. Waymo's been on the street. They like you own a car that's got supervised full self-driving. You have an S in front of your FSD. Like,
yes,
you know, and
right
so
now. And
yeah,
I think there's an interesting open question about between the robotaxi business. I think they'll be able to deliver as someone who has FSD. When will that be able to be unsupervised? And when it can be unsupervised, are they going to have an operator that is overseeing it in a data center somewhere? That's an interesting question, because I've paid up front for something that is a price that didn't accommodate, you know, the labor cost of an operator overseeing my vehicle as I'm sending it off to park. And so I don't know how they're going to, like, they may hold off on delivering unsupervised while they're scaling out robotaxi. Just because we don't know to what degree the operators will need to be instrumentally involved. But the reason 2032 is ridiculous is you can look at.
By the way, I'm a dummy. I already told you this. I'm a dummy. I'm a screamy fast money guy. I just pulled that out of my ass. Okay. But my point is, I'm just taking the over. That's all I'm saying, Brett.
Yes, but the over, like, oh, they're not going to deliver this capability in 6 months. Instead, it'll be 12 months. Actually, doesn't really matter. I mean, it matters. Maybe it matters to you, because then you can say, you should have taken the over for the next 6 months. But over 2 years, if you're naked the stock because you said, oh, this was going to take 6 months instead it took 12, you're in huge, horrible shape. Like you.
Well, why is this the
huge value creation event?
Why is this the worst performing mega cap tech stock over the last 5 years?
Because
like,
people
it's
don't
literally,
believe in
it's literally.
I mean, like I said, I think the auto business is a really challenging business. I think that their factories aren't fully utilized. Like, they will want to and will try to sell kind of 3 million vehicles on their current factory footprint, and they'll do that by delivering more economical models. They'll deliver like a 3-row Model Y for people that want like minivan style type.
Dude, this is
travel.
so 5 years ago. This is like that mass market $25,000. They're just stripping down an already stripped down Model 3 or Model Y, and then you take the credits out of it and this and that, whatever. The auto business is kaput. It's done. It's saturated.
The auto business is just the razor business to the razor blades that is robotaxi. And so I think, and to be honest, I am so glad that I personally own Teslas, because I think it's going to be a hard thing to personally own in a couple of years.
Oh God! All right, listen,
Yes.
you and I, listen. You've been so generous with your time. I've learned so much. I think a lot of our listeners are sick of me arguing with really smart people about Tesla, but maybe we can have just a Tesla conversation if you would be so kind to come back, Brett.
Because yes, I will happily. We can go to the mat on this one.
Listen, I said I'm the dummy, okay? And so
actually, let me make one last point, because the reason it's obvious to me that this is going to happen with Tesla, but also with humanoid robots, that's not necessary. Tesla is well positioned, but there's no guarantee that they win there. And that is the forecast that's moved the most to the left for us. And it's because all of the capability increase you're seeing in language models, the fact that you can do the same thing this year for 1/50th the cost that doing it last year would have been, translates just at some delay into the embodied robotics space, including robotaxis. So the idea that in this domain we can throw a lot more compute at it and get a lot more performance, but in that domain that's not possible, I don't think is an intellectually honest position. And so what is Tesla doing? They have this Cortex data center that has, call it 50,000 accelerators in it. They're building, Cortex 2, which is going to have, we don't know exactly how much, but maybe 5x the wattage thrown at it against computers that are going to become twice as efficient for watt. So it's going to be 10x more compute thrown at this problem. So it could be that they don't quite have enough compute to process all the raw data to deliver the software package today. But over the next 12 months, at least just looking at kind of like the way we run the forecast, it's almost inevitable that they'll cross this performance threshold. And then once they do, just the economics will dictate that they throw all production into servicing robotaxi. We're not going to need to drive. You have no idea what a huge human capital unlock that is. Like our beautiful brains are being wasted operating these 2-ton vehicles. We could be doing much more interesting, creative, phenomenal stuff, or we could be watching Netflix, but we'll be doing something else. And that'll be great. That'll be great for everybody.
I love this conversation. Let's start it over with me not being as hyperbolic about it. I appreciate everything, Brett. I really do appreciate you spending the time here. I know our listeners will too, and I hope we can do it again.
Great. Thanks for having me
on.
Thanks, man. I'm at Winton ARK on X, and you can catch me on the FYI podcast at ARK Invest. And thanks.
Well, I appreciate that. We're going to put all those links in the show note. You are a great follow on Twitter, and I look forward to listening to your podcast. So, Brett, thanks so much. I appreciate it.
Cheers.